Good afternoon.
Afternoon.
Welcome to our session this day. We want to do a question from Consolidated past paper, November 2019, Advanced Financial Reporting, question 4. Now, Frank will help us with the question. Frank, read the first question very fast.
The following financial statements relate to Makongeni Group for the year ended that 1st October 2019. Makongeni Group Consolidated Statement of Financial Position as at that 1st October 2019-2018. Assets in Kenya shillings, millions. You have non-current assets, property, land and equipment. 2019.
Okay, don't read the figures, just read the information. Don't read those values.
Property, land and equipment, goodwill, investment in associate. Current assets, inventories, trade receivables, short-term investments, cash and bank balances. Then we have equity and liabilities. Equity, ordinary share capital, revaluation surplus, retained earnings, non-controlling interest. Then we have non-current liabilities. We have bank loans, deferred tax. And we have current liabilities, trade payables, current tax, then total equity liabilities. Makongeni Group Consolidated Statement of Comprehensive Income for the year ended that 1st October 2019. You have revenue, operating expenses, profit from operations, gain on disposal of subsidiary, finance costs, share of profit of associate, profit before tax, income tax expense, profit after tax for the year, other comprehensive income, revaluation gain on property, other comprehensive income of associate, total comprehensive income. Then profit for the year attributable to owners of the parent, non-controlling interest. Then you have total comprehensive income for the year attributable to owners of the parent, non-controlling interests. Additional information. During the year, Makongeni Limited acquired 80% of the ordinary share capital of Razak Limited, paying a cash consideration of 6 million. The non-controlling interest holding was measured at its fair value of 1.36 million at the date of acquisition.
The fair value, continue. The fair value should be here. The fair value.
The fair values of the net assets of Razak Limited as at the date of acquisition comprised the following: property, land and equipment, inventories, trade receivables, cash and cash equivalents, trade payables, tax payables. During the year, Makongeni Limited also disposed of its entire 60% ordinary shareholding in Salama Limited. The subsidiary had been acquired several years ago for a cash consideration of 2.4 million. The non-controlling interest holding was measured at its fair value of 1.28 million as at the date of acquisition, and the fair value of Salama Limited's net asset was 2.92 million. Goodwill on acquisition of Salama Limited had not suffered any impairment. At the date of disposal, the net assets of Salama Limited had carrying values in the consolidated statement of financial possession as set out below: property, plant and equipment, inventories, trade receivables, cash and cash equivalents, trade payables.
The short-term investments are readily convertible into known assets of cash, and there is a significant risk of their fair value changing. Depreciation of shillings 1.540 million was charged during the year. Plant with a carrying amount of 1 million was sold for 1.1 million Kenyan shillings. The gain on disposal was recognized in the operating profit. Some expenses were devalued during the year. Some properties were revalued during the year, and the revaluation gain of 800 million being reported. Ignore the deferred tax on revaluation, on revaluation of property, plant and equipment. Required consolidated statement of cash flow from the Makongeni Group for the end at 31st October 2019 using the indirect method in accordance with the International Accounting Standard IS7 statement of cash flow. 20 marks. So this one you answer according to IS7. Not according to Frank or Brighton. It's according to IS7. Now IS7 requires that when you are consolidating cash flow, we categorize activities into three. We have got cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. So now, now we are going to find out, and one thing also you need to realize that this is a consolidated financial statement, whereby the first thing here is that Razak, there's a new company that was acquired by the name Razak. Razak, they acquired 80%. Of course, when you acquire 80% of a company, you are controlling the company in terms of voting rights. They also had initially, they were controlling initially 60% of another company called Salama Limited. Good. So then of course you can see the net assets that were acquired for Razak and the net assets that were disposed for Salama in terms of PPE, in terms of inventories, in terms of trade receivables. So we are going to run many T accounts in this case. We are going to run many T accounts and we are going to have many workings. So the person in charge of the video, ensure that you follow up. So we want to start with working one. So we have workings here. Workings. So one I want us to first of all look at some of these assets that were. Let's look at first of all the gain or loss on disposal. Gain or loss on disposal of Salama. Disposal of Salama Limited. Salama Limited. So, if you read it, note number 2, they said during the year Makongeni Limited also disposed of its entire 60% shareholding in Salama. So now, if you want to know the gain on disposal, gain or loss, so gain or loss on disposal is always the cash received from disposal minus the net asset disposed, minus the net assets disposed. Minus the net assets disposed. So now, if you look it very well, you are going to see that in this case, we are not being given the cash that was paid, that was received from disposal of this asset. But what we were given is the, if you look at the statement of comprehensive income, there's gain on disposal of subsidiary, which was 400 million. So you're going to say 400 is equals to, of course, we don't know cash received, we can name it X, cash received, minus net assets acquired, minus net assets acquired. So net assets acquired, in note number 2, they say that at the date of disposal, the net assets of Salama Limited had the carrying values in the consolidated statement of financial position as follows. So if you follow up from PPE to inventories to trade receivables up to trade payables, the figure was coming to be 3990. So by the time they're disposing, the net assets was 3920. That was the total assets of Salama. But since it was controlling 60%, we are going to dispose that 60%. Because we are not disposing NCI, we are not disposing non-controlling interest. And of course, you always also add unimpaired goodwill. Now, that's a question we need to compute goodwill. Let's compute goodwill first so that you can know that the goodwill that had not been impaired, because you can see they wrote that the goodwill acquisition of Salama had not suffered any impairment. So let's look at goodwill computation as working 2 before we come back to working 1. Goodwill computation. Here we are going to have, of course, let's just compute both of them for Razak Limited and Salama Limited. Razak Limited and Salama Limited. So consideration for purchase consideration for Razak was 600 million. In note number 1, they say that during the year Makongeni Limited acquired 80% of the ordinary share capital of Razak Limited for a consideration of 6 million. So the cost of Razak was 6 million, and the cost of Salama was 2.4 million, or 2,400. And then they had about NCI fair value, NCI, the non-controlling interest fair value. For Razak, you can see it was 1360. So they are using full goodwill computation, the full goodwill method. And then for Razak, as for Salama, the fair value was 1280. So my good students, Frank, can you get for me the total of this? This will be 7360. This will be 80. 680, right? Yes. Now the net assets acquired. If you check for Razak, the net assets that were acquired for Razak is in note number 1. Still, they say the fair values of net assets of Razak as of the date of acquisition was totaling to 5960. So net assets acquired was 5960. And then for Salama, the net asset was 3920. 3920, but okay, let me see. Okay, no, by the time of acquisition, sorry, this is that was the value at the time of disposal. By the time of acquisition, the net asset was 2920 at the time of this acquisition. So the difference will give us goodwill. So goodwill, of course, this will be 00. This will be 1400. And then this will be 06. This is 7. This 1760. Frank. What's the difference here? That's 680 minus 920. It's okay. So that's the goodwill on acquisition. So anytime, so that's how you get goodwill. The consideration they used, yes?
I think it's 760.
760, good, thank you. If you want to compute goodwill, of course, this is full goodwill method where we are going to use the purchase consideration and also the fair value of non-controlling interest. Non-controlling interest are the minority shareholders. So you get their fair value, so you get goodwill. So this goodwill is going to assist us again when you are running the goodwill account. At the same time, when you are disposing this asset, when you want to know the gain or loss on disposal, you're also going to apply goodwill. So the goodwill that was disposed for Salama was 760. And since it had not undergone any impairment, we just disposed it in full. So plus 760. So this will be, yes, Frank, what is 60% of 3920?
$23.52.
2352 plus 760.
3112.
3112. So if you take that figure of 3112, 3112, of course the coefficient was negative, right? If you open the bracket, the coefficient was negative, so it will be negative. So it will appear like negative 3112. So it will be 400 is equal to x minus 3112. Of course, if you take this negative, the other side will be positive. So x will be 3112 plus 400.
3512.
3512 is equal to x. So x, this is the cash received. This is the cash received from disposal of Salama Limited. Salama Limited. So that is also in conjunction with IFRS 5. That is non-current assets held for sale, IFRS 5. So anytime you dispose an asset, you dispose it for money or for cash. So if you'll be checking at the cash received from disposal of Salama Limited, you know this is the value. Good. So because I ran the goodwill, now let's run the goodwill account. If you get back to our question, in the first page, let's run the goodwill account. Let's run goodwill account, my good students. Goodwill account. I don't know whether this place is small. Let's try to see it. Goodwill account. You can see in our first page, we were given the information on non-current assets, where we had property, plant, and equipment, and then there was goodwill. So goodwill for 2019, because goodwill is an asset, we have to run that account, and that asset becomes our debit balance brought down for 2018. So balance brought down for goodwill was 7,400. You can assist me in getting it. 7,400. And then balance carried down, which is the closing balance for goodwill, was 7,720. 7,720. 7,720. And then because we are adding asset, you agree that anytime asset is added, we debit that asset account. Anytime an asset is disposed or an asset is reducing, you credit the asset account. So because this company bought Razak, so you're going to add the goodwill for Razak. That means you're going to debit Razak, goodwill for Razak in the goodwill account. So you call here Razak Limited, 1,400. And then because we are disposing Salama, we write Salama Limited here, which is 7,600. So we are going to balance that account. If the so Frank, add for me the value on the debit side. 7,400 plus 1,400.
8,600.
8,800, right?
86, 88.
8800, 8800. So 8800 minus 7720 minus 760.
800 minus 7720.
Again minus 760.
Minus 760. 320.
Huh?
320.
320. So that 320, that figure we call impairment loss of goodwill. That is what we call impairment loss. So that means since intangible assets don't depreciate, what they do is that they impair. That is IS 36, impairment of intangible assets. So again, we are going to see how we are going to disclose that in the cash flow from operating activities. Having done goodwill and having gotten the consideration, we can now check on PP. We can run property, plant and equipment account. We can run PP. And run our PP accounts. And if we start with that will be our working three. PP account, that is property, plant and equipment account. Again, this is an asset account. I know assets account have debit balance go down and credit balance carry down. So balance go down for PP is the one we have for 2018. Balance go down being 6,500. Balance carry down being 10,180. 10,180. Let me try to extend it a little bit because, of course, there are those properties that were revalued, and we have to look at even the revaluation reserve. So balance carry down is 10,180 for property, plant, and equipment. And then they're telling us that in note number 2, they're saying that when they were acquiring Razak, they also bought some property, plant and equipment. So we call it Razak. The property, plant and equipment for Razak was 5120. And then when they're disposing Salama, they also sold Salama in some PPE worth 2,900. And then, of course, we also had the issue of after Salam. Of course, we had depreciation, which was 1,540, and we also had revaluation in the last note, revaluation reserve or revaluation surplus. Again, as we do that, we can also run revaluation reserve account. We can run revaluation reserve account. Revaluation reserve account. Of course, revaluation reserve is an equity. I know that equities have credit balance go down. So if you come back to your PP, you find that revaluation reserve the balance go down was 2,100. Then the balance carry down, we had 3,000. And of course, if you look at the last note, they say that there was a revaluation surplus of 800. So you can write here PP of 800. Sorry, should be this side. PP of 800. Then you can also say a revaluation of 800. So, of course, if you balance this account, this will be 3,000, and this will be 2,900. So it's not balancing. So you ask yourself, what was that question? What's the remaining 100 that is not balancing the revaluation reserve? Then you come and look at the current assets. There are some short-term investments. Some of these short-term investments short-term investments. Some of these short-term investments also underwent revaluation. Of course, it's an asset, it has a debit balance go down. Balance go down. For short-term investment was 200. And then balance carried down was 300. So the difference here is revaluation again. Revaluation, which was 100. So the other account is balance 300, 300. And now you can also call here short-term investment 100. So it's coming to 3,000, 3,000. So we have closed the two accounts without any deficit. Now balancing now our PP account. So Frank, you'll add for me the credit side, the value of credit side, so that we can know any additional cash they spent to add more property, plant and equipment. So add 29 plus 1540. Okay, sorry. There's another note here I'm forgetting. In note number 3, I think 4, they say depreciation is 1540. Charge, and then the plant carrying amount of 1,000 was also disposed. So there's also a disposal of value of 1,000. 1,000. So add for me the debits, the credit side now. 1,000.
5440.
Yes?
54.
That is? This 10,000, 180, this 1,000, this 54, this 900.
Fifteen six 20.
15,620. 15,620. So balancing figure. That answer deducts all these figures. Remove from these figures that answer. Get the balancing figure.
That 200.
3,200. So this answer we call it cash. Was cash paid to acquire PP or addition. So they spent some cash worth 3.2 million. No, 3.2 billion. So because there are millions to add more PP. So that is cash flow from investing activities. Because anytime you invest in fixed assets, that is investment. So you're going to do that one when you're consolidating this cash flow. So having done property, plant, and equipment, the next asset I want to work on, because I worked on goodwill, I've also worked on PP. Now let's finish with investment in associate so that we can check on current assets. Investment in associate. Investment in associate account. Investment in associate account. So this is going to help us know how much dividends did we receive from associate. How much dividend did we receive from associate? And you know that accounting for associate is found in IS 28. IS 28. So this being an asset, of course, it has a debit balance go down. Investment associate was amounting to was 2160. Then balance carried down was 2480. 2480. But then there is profit from associate in the statement of comprehensive income. You can see a share of profit from associate, which was 460. So you bring it here. You can call it P&L account. P&L account, which was 460. And then you balance for me that account. What's the total here? Is it 2620?
20. Yes.
What's the balance? You figure the difference? 2620 minus 2480.
140.
140. So that is the dividend we received. Dividend received from associate. So it's also an income, but it's from investment activity. So I think we are done with the non-current assets. Let's now talk about current assets. That is inventory. So let's run inventory account. In what finance we call it working capital management. Inventory account. So here. So this also being an asset, it has a debit balance go down and a credit balance carry down. As William doing in section 6, you should not wonder what I'm doing. Now, so inventory balance go down was 1740. 1740. Then balance carry down. Balance carry down being 1880. 1880. And then let's look at Razak. Razak Limited came with the value of inventory amounting to 600. So Razak Limited 600. And by the time we were disposing Salama, inventories we disposed was 660. So Salama was 660. So again, we are going to look at these are what we call in finance cash equivalents. Then they are not necessarily cash, physical cash, but their movement shows how also cash were moving. So we call them cash equivalents. So again, Frank, you're going to look for me. Which side is more between debit and credit? I think credit will be more. 1660 plus 1880. 20, 25, 20, 40.
40.
Minus that goes on.
23, 40.
Minus 600 minus 1740. So that is increase.
1440.
2540 minus 600 minus 1740.
Huh? 25?
40 minus 600 minus 1740.
200.
200. So this is increase. Why am I saying it's increase? And this is because we call them cash equivalents. We are assuming that cash is moving out. Because anytime you buy more inventory, anytime inventory increase, the assumption is that you're buying more stock. So cash is going out. So that is an increase in inventory. Let's run trade receivables and look at how they're moving. Trade receivables account. Trade receivables account. So these questions require that you be very fast, because if this is just one question, if you're not careful, it can consume your 3 hours. Again, here balance go down was for trade receivables was 1320. 1320. Balance carry down for this was 1560. 1560. And then how much did Razak came with? Razak came with the trade receivables of 960, amounting to 960. Salama went with the trade receivables of 480. Frank was the answer here. Which one is likely to be more? This side. Or the other side?
This one.
This one.
This one.
This one. Okay, what was the total?
15 not.
1560 plus 480.
2040.
2040.
Yeah.
2040 minus 1320 minus 960.
But this side will be more.
Yeah, but I asked you. So this side is how much? 1320 plus 960.